We've said it before on this show, most Americans aren't actually that familiar with the exact state of the US economy. Yes, they kind of know how aspects of it are affecting their own daily lives. Inflation, for example, has meant everything's gotten more expensive. Wallets are being squeezed, bills are getting higher, gas prices. But that doesn't necessarily reflect how the overall economy is doing. The employment rate is a great example of that. Normally, jobs are a major indicator of the state of the economy. And last week, Joe Biden announced that not only is our unemployment rate at a historic low, job growth has been doing really, really well too.
Just look at today's jobs report. Our economy created 263,000 jobs last month. That's 10 million jobs since I've come into office. That's the fastest job growth at any point of any president in all American history.
In fact, the unemployment rate stands at just 3.5% for the month of September, tied for the lowest figure for the past half century. An astonishingly impressive statistic. And yet, if you look at the polls today, one of the top issues troubling Americans ahead of next month's midterms is, you guessed it, the economy. A Monmouth poll taken last week found that 82% of Americans ranked inflation as an extremely or very important issue, more than anything else surveyed. Unemployment got a lot of votes as well, compared to abortion at 56% and climate change at 49%. Of course, Republicans are really leaning into that, even amplifying alarm for their own partisan political gain. And it's working, even if they, the Republicans, don't have any kind of economic plan of their own. According to a Washington Post ABC News poll from last month, Republicans hold a 17 percentage point advantage among registered voters on who those voters trust to handle the economy. They had an 18 percentage point advantage on the specific issue of inflation. Again, they don't have a plan of their own, but it doesn't seem to matter. So not only do Republicans have an advantage on the economy, many would say an unfair advantage, but there's even more bad news on this issue for the Democrats. For the last few months, America's central bank, the Federal Reserve, headed by this man, Jerome Powell, has been going all out trying to curb inflation by raising interest rates. It's a classic move that slows down the economy as people and companies stop borrowing money, essentially. Here's the big risk, though. If you slow down the economy too much, the growing jobs market, the high spending, the rising prices, you risk slowing it down to the point of recession, where companies just stop hiring, unemployment goes way up, and well, you remember things like 2008, right? Powell's aggressive approach to inflation right now might destroy the one good thing we have going, the jobs record. He's planning to raise interest rates again and again, and it's already been raised 5 times this year. It's an approach that Powell himself admits will cause significant economic pain.
What is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. You know, higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it.
Have you noticed how it's always the people who never really feel economic pain themselves who speak so casually about economic pain? Look, as I said on this show last week, a, quote, softening labor market is just a horrible euphemism for unemployment. In fact, economists are predicting that rate hikes could lead to an additional 1 million people without jobs. 1 million. Look, I get it. It's a delicate balance to bring down inflation while trying to avoid recession or job losses. But the approach Powell, a Trump appointee, I should remind you, is taking is scaring a lot of well-qualified folks. Last week, a UN agency warned that the Federal Reserve's moves are risking pushing the global economy into recession if they keep raising interest rates. The World Bank made a similar warning just last week. As New York Times columnist and economist Paul Krugman wrote last month, the risk that the Fed is moving too slowly to contain inflation has declined, while the risk that high interest rates will cause severe economic damage has gone up a lot. When will we learn? This isn't the first time we've been in this position. In the 1970s and 80s, the Fed, under Paul Volcker, raised the interest rate so high and so quickly that by 1982, under Ronald Reagan, the unemployment rate reached a dramatic 10.8%. 12 million Americans were out of a job. It was the highest unemployment rate at any time during the post-World War II era. It did finally reduce inflation. Prices did come down, but that was following nearly a decade of persistent high prices, much higher than today. And so it was a very different scenario than the one we face right now. The question, therefore, is Powell the new Volcker? Is that where we're heading? And if we are, shouldn't the Democrats remember what coincided with and followed Volcker's draconian rate hikes? 3 Republican presidential terms in a row, and millions of Americans out of work for years. If we keep raising interest rates going forward, sure, prices might get under control. Inflation might finally be curbed. But we have to look at the history. We have to heed the warnings and really ask ourselves, at what human cost? Who better to discuss all of this with than Alan Blinder, a former vice chair of the Federal Reserve himself and current professor of economics and public affairs at Princeton University. He's the author of a new book out this week called A Monetary and Fiscal History of the United States, 1961 to 2021. It tells the story of U.S. economic policy essentially from Kennedy to COVID. And we're also joined by former U.S. Secretary of Labor and current professor of public policy at UC Berkeley, Robert Reich. Robert's also the co-founder of Inequality Media and the author of the 2020 book, The System, Who Rigged It, How We Fixed It, which is now available in paperback. Both of my guests, interestingly, served in the Clinton administration. Thank you both for joining me on the show today. Alan, let me start with you. Put what Jerome Powell and the Federal Reserve are doing right now in historical context for us, because this is an aggressive approach to tackling inflation, but not the most aggressive we've seen in U.S. history. So how valid, in your view, are the warnings from the UN, the World Bank, Paul Krugman, and others?
I think the warnings are valid. The question, unfortunately, is how else do you do it? I mean, the Fed, you said it yourself, the Fed doesn't have a magic wand. It has control over interest rates. Interest rates do squeeze spending, and certain categories of spending, especially like automobiles and houses. That does cost jobs. The good news is we're starting this process from a very strong position. We're starting from an unemployment rate of 3.5. And that means to me, if the unemployment rate goes up somewhat, you never like it to go up, but it's not a calamity like the 10.8% unemployment rate you were just pointing to. We're starting from 263,000 jobs, net jobs created per month. That'll go down, but it's still positive. It's not already negative. It may go negative. But, if you think about how much does it have to fall, if you're starting at a very good level, that eases the pain somewhat. And then the other thing I would point to is, unlike what Volcker faced, and he really faced a difficult problem when he became chairman of the Fed, inflationary expectations are not that ingrained and entrenched in the minds of business people, consumers, traders in the bond market. They all see it. They all recognize that we have high inflation. And as you said, they don't like it. But they haven't been living with it for 5 years or 10 years or anything like that.
Bob, respond to Alan there. The Fed doesn't have a magic wand. What else are you supposed to do in this situation?
Well, first of all, let me just say, Alan Blinder, it's good to see you again. I think the response really is one of pacing, is speed. And the problem is that the Fed just doesn't know exactly what the future is going to be, doesn't know what the trade-off is going to be. And so the argument would be that in that kind of a situation, when you don't know the future, when you have at least a risk of causing recession, imposing huge costs and hardships on many people, many of them your most vulnerable people. I mean, it's the poor who are the first to be fired, the last to be hired. Well, what you want to do is go slowly and see if you've had the right result. The Fed has moved very, very fast. It's had 5 increases really in a very, very short amount of time. And therefore, the hope would be, the recommendation certainly that I would make, would be to just slow down. Just give it some time. There are lag times between when the Fed raises interest rates and the actual results in the economy. Let's see. Before you raise interest rates again, just slow it down and let's see what your interest rates today have actually done.
And Bob, isn't the problem that whether unemployment goes up or inflation goes up, it's the poor that suffer most? It's built into the system.
Yes, the poor suffer most. Again, they are the first to be fired, the last to be hired when the economy turns up again. Also, a lot of workers have not got any raise. I mean, for the last 40 years, adjusted for inflation, with the wages of at least 40% of America have been absolutely flat. And what you want to do, a tight labor market, when employers really don't want to hire people, that's a good thing. That's not a bad thing. You want to allow that to go on as long as possible. The other thing, very quickly, I want to say is that this inflation is a worldwide phenomenon. I mean, the United States inflation is not nearly as bad as it is in most other places around the world, and therefore, because it's worldwide, maybe you have reason to think that the causes of inflation are not necessarily your wages or your jobs in the United States.
I do want to come back to you on that in a moment, Bob, on the worldwide angle. But Alan, there's this idea of so-called soft landings where we managed to reduce inflation without causing a major recession. Critics have said this has only happened maybe 1 in 11 attempts over the last 60 years or so, in 1994, I believe. You recently wrote about this in the Wall Street Journal, and you said, quote, a careful historical analysis suggests the Fed has managed a soft landing or came close in 6 of the 11 cases. To be sure, landing the economy softly is a tall order, but success is not unthinkable. The Fed has done it before. Are we on track to do that now, do you think?
Well, that's the $64 trillion question. I think it's a live possibility. I think given the shocks that we're experiencing, and as Bob said, they're global shocks, and that we shouldn't forget about that. It's going to be a tough road to hoe, but possible. And the Fed has done it before. If you take out the 70s and 80s when the Fed, not at first, but then under Paul Volcker, was fighting a really virulent and deeply entrenched inflation, we had some very, very hard landings. And that's one of the reasons people have come to think it's impossible to land softly. But we did it in 1994-5 when I was on the Fed. Easier circumstances than now, to be sure, but we did it. And there are a number of other instances. I coined, when I wrote about this, the word softish. I didn't check to see if that was in Webster's dictionary. But what I mean by that is on the soft side. So the economy does decline a bit, but not a lot, maybe a 0.5 percentage point decline in GDP or 1 percentage point decline in GDP. Any decline is unfortunate. But as I said, without a magic wand, you're going to have something like that.
Bob, let's talk about the global angle that you mentioned. We've seen gas prices, for example, first go down consistently over the last couple of months and then start to tick upwards. The federal government, the United States government, had asked Saudi Arabia to pump more oil back in July. The Saudis have said earlier this month, they've announced they're going to be cutting oil production. OPEC is cutting oil production. The American government is very upset. It could affect the midterm results. Joe Biden's talking about reviewing Saudi relations. How major an impact is this oil price hike, what some people are calling an October surprise?
Well, it certainly is important. It's important both because obviously people depend on energy. It affects energy prices across the board. It's important because politically people see at the gas pump very large numbers that tell them exactly what they're paying, and they know what they were paying last month or a year ago. It's also very important because it has a tendency, and oil and energy prices generally, to have a multiplier effect through the entire economy. But maybe if I could just add one more point, and that is that we've got to also beware that corporations like Chevron, big oil companies, are really doing huge markups. They are enjoying windfall profits. And that's another piece of the puzzle. I mean, we can't rely solely on the Fed here. Even the conservative government in Britain has put a windfall profits tax on the oil companies. Why can't we?
It's a very good question. One last question for you, Alan. You start your new book by talking about the importance of history. You say, one thing I've learned is that my fellow economists have a remarkable propensity for forgetting or ignoring the past. Alan, would you include Jerome Powell in that list? Do you think he's heeding and studying the past while making these monumental, hugely consequential interest rate decisions?
I think he is. By the way, he's not one of the fellow economists. He's not an economist. He's a smart man, though, so you don't have to be an economist to lead the Fed. I don't think he's forgetting the lessons of history. And one of the lessons that he's remembering very much, for better or for worse, but I think he needs to remember it, is that once inflation gets deeply entrenched into the beliefs and the contracts that are all over the economy, it gets very difficult to remove it. And we're not there yet. We're not there yet. And that's one of the reasons I think there's still hope to land the economy relatively softly.